All right. Thanks everybody for joining us today. We're going to go over the alphabet soup of all the different health care savings plans that are offered here in the United States, and how they are effective on taxes, and also for future healthcare planning, different types of insurances and that type of thing. Normally I like to gloss over the disclosure, but this one I want to let you know that everybody's situation is unique, and you should definitely speak to a tax professional, health insurance professional, and financial advisor to make sure that you're not missing anything. We happen to have all three of those here in our building, so we're very proud to offer that service that allows you to really get the best information on this complicated issue. First thing we're going to talk about is health savings accounts, HSAs. So who's eligible? Anyone with a high deductible plan that's under age 65 can contribute to an HSA. You cannot have any other types of insurance in place. So it doesn't matter, if it's secondary or primary. If you have some other type of plan that does not meet the qualifications, then you would not be eligible to make contributions in that year. Both an employer and an employee can contribute to an HSA. And what is a high deductible plan? Well, it's going to be those, you have to have a minimum deductible of $1,500 per individual, or $3,000 for a family. And then your max out of pocket has to be a minimum of $7,500, or that doubles to $15,000 for family as well. So it's one or the other is going to be a qualifying requirement to be considered a high deductible plan. In 2023, you can contribute $38.50 for a single, and that doubles for a family. And if you're over 55, there's also a $1,000 catch up over and above those totals. Benefits for an HSA, they're tax deductible going in. They're tax-free coming out, as long as it's for qualified medical expenses, and we'll define what that is. Your account value rolls each year, and it's portable, meaning that you can transfer it to another holding. That means that it's not necessarily stuck where your employer decided to have that. You can transfer that over to a different custodian, and the investment options are kind of open at that point. You can name a beneficiary, so if you pass away, the money doesn't just disappear, you can pass it on to the next generation. Your expenses also have a look back period. So as long as you've had an HSA, you can go back and say, well, I'm going to make a withdrawal for this expense that I didn't reimburse myself for previously. We'll talk a little bit more detail about what that looks like right at the end. And I mentioned, it can be invested for higher earning potential as well. Qualified medical expenses for an HSA are going to be out-of-pocket medical costs, including doctors, hospitals, dental, vision, kind of anything that you would assume is going to be through a medical professional. Out-of-pocket prescriptions also count, and something that's new as of 2019, over-the-counter medication and devices are also considered to be qualified medical expenses. Previously, FSAs, flex spending arrangements, allowed for this, but HSAs did not. So if you're buying cough medicine, that type of thing, you can use your HSA to pay for that type of thing as well. Premiums for long-term care, COBRA, and any health coverage that you are paying for while unemployed. That's kind of the one time that you can have regular premiums that are covered with the HSA if you are receiving unemployment and paying out of pocket or something other than, COBRAs all the time, but so this is kind of a unique situation. And then Medicare premiums as well. Some challenges that HSAs offer. Withdrawals for non-medical expenses are taxed at regular income rates plus a 20% penalty if you're under 65. Now, the penalty goes away after you reach 65. So if you are super healthy and never need the money for any kind of medical expense, it basically becomes an IRA at that point because there's no penalty, but you are paying taxes on the growth. Well, actually, the entire withdrawal because it goes in tax-free. So if you use funds, that negates medical expense itemization. So if you are itemizing a Schedule A, you used money from your HSA to pay for medical expenses. Now that doesn't get deducted because ultimately that would be double dipping because you're not paying taxes on the withdrawal, but you can also deduct that. So contributions must stop 6 months prior to enrolling in Medicare. Ben, our Medicare specialist, is going to touch on that a little bit as well. Contributions and distributions must be reported on a 1040. So basically, at the end of the year, you're going to get some tax forms from your HSA account. There's going to be a 1099 that lists what comes out, and then a 5498, and that's going to list what goes in. But that doesn't necessarily tell you what exactly the expenses are being used for. So your tax preparer doesn't know. As a default, I always say that it's all used for medical expenses. If it's not, you definitely should let your tax professional know, because together we might be making a fib, or in some worlds that might be considered fraud. It's not really fraud if it's an error, but we definitely want to be as accurate as possible. Distributions are subject to receipt requirement. So if the IRS comes calling and says, hey, you had a lot of HSA money that went out this year, do you have receipts to back that up? Not a real common practice, but definitely is something that is required. So if you use your HSA account now, previously had a question last month when we did this. Well, if I have the HSA card and all my expenses go out on basically that credit card or debit card, is that enough of a receipt? Technically, no, but in practice, yes. So it's up to the IRS agent who's kind of doing the audit. If you keep a ledger, that's typically enough. Some sort of written documentation, and the IRS will typically work with you. If you have a stickler of an agent, they could request actual receipts from the medical professionals that providing, from the pharmacy that you're getting the prescriptions from, those types of things. So you may not be able to max fund your out-of-pocket expenses the first year just because of the limits that are going in. So that's just kind of a math problem more than a problem with an HSA. MSAs, or medical savings accounts, are very similar to an HSA, but this is for small businesses or individuals who are self-employed, that type of thing. These have definitely some benefits, and they are being phased out. So if you were self-employed back in 2007 or previously, and you started a MSA and you keep that in place every year, that's the only way that you still have one. You can't start one after 2008. So you have to continue to keep that in place. Your eligibility requirements state that you have to have it the previous year. So it's a continuous plan dating back 2007. Otherwise, the rules, tax treatment, kind of everything else is very similar to the HSA. One thing is that you are required to do your own tax filing. So the 8853 is unique to the MSA because it's for someone who's self-employed, so they don't have the employer taking care of the paperwork on the tax reporting side for them. Flex spending arrangements. This is kind of the one that people know as use it or lose it. So part of your compensation, usually as an employee, is that you have this account open and available to you to pay for medical expenses. If you don't use up what's in that account by the end of the year, typically that money goes back to the employer. So they're usually the ones that are contributing. As an employee, you can contribute, but keep in mind that you have to use it by the end of the year. It's not portable. You can't transfer it. You can't name a beneficiary. So this is more of a fringe benefit plan than anything else. Health reimbursement arrangements, or HRAs. Contributions, they're not included as income, so it's not taxable, it's not reported as tax. The plans are reimbursements for healthcare expenses. Usually what these are set up is they'll pay for your medical premium. So if it's a small employer, they don't qualify where they have to provide insurance, but they want to give some sort of a benefit. So they'll give a $500 a month or whatever it is, and then you can go and buy a plan on the open exchange, that type of thing. Balances can be rolled, but they're not portable. So it can go from year to year. If you don't use it, the amount carries over. You don't lose it at the end of the year. But in most cases, you can't transfer that to another individually held HRA plan, something like that. If there's money left over when you pass away, you can name a beneficiary, but at that point, it's usually going to be a cash out option only, and that's going to be taxable to your beneficiary. Plans are set up by the employer, so they may cover your spouse, they may cover your children, they may not. It's all going to depend on what the employer establishes, and only your employer can make contributions to this. There's no limit how much they can put in, but you as the employee cannot contribute. Qualified medical expenses are different for an HRA. You can use this for just regular health insurance premiums, whereas the previous three plans we talked about, you cannot. You can use it for long-term care, and then you can use it for items that are not covered by your health insurance plan. That's kind of a vague definition, but it's similar to like the HSA, where you can pay your deductible, you can pay your dental, vision, those types of things, and then also prescription medication, that type of thing. So with that, a lot of complicated issues here. Record keeping is probably the biggest headache that comes along with any medical savings account, regardless of the category that falls into. And we want to help you navigate this. So in-house, if you're pre-65 and you don't have coverage through your employer, probably want to go on the Affordable Care Act. And we do have a specialist here, Shane Roth, and he's going to come up and talk a little bit about some items that come about in that world. Start with you.
Wait, I need to what?
Start the video.
Oh. Morning, everyone. Shane Roth. I am our pre-65 healthcare specialist at Wealth Distribution Strategies. I'm going to go over a little bit about some some of the confusion surrounding HRAs. I pulled a little blurb here off of healthcare.gov, and I'm just going to read that quick. Your individual coverage HRA offer may impact you and your eligibility for a premium tax credit that helps lower monthly insurance payments for marketplace coverage. The impact on you and your dependents on the affordability of your HRA offer, which is based on the dollar amount of the employer contribution and your annual household income and the monthly premium of the self-only lowest cost silver plan available to you through the marketplace in your area. Employees and dependents who are covered by an individual coverage HRA or who are offered an affordable individual coverage HRA can't qualify for premium tax credits. So with that, I'll conclude that we all understand what HRAs are. I'm kidding. No, so what that says is basically your plan could be qualified or not qualified, and we need to determine if it is qualified. Because if it's qualified, that means if you have that offered to you and you don't take it, you may negate your subsidy. If it's non-qualified, you can actually decline it, but it is on you to decline it. Now, the big factor in figuring out whether it's qualified or non-qualified comes down to what are we looking at here as far as the factors? Well, it's your age, your zip code, your income for the year, and your whether or not it's going to, what benefits it's going to cover. So through the ACA, you can actually get to a calculator. Give me 1 second. I got to switch the share here. Share. Too basic. So if you go to healthcare.gov, there is a calculator there. Share that. Of course, now I can't see the. I've got the Zoom menu here. Can I get rid of that? All right, so we'll use the zip code here. We're going to use 53574. We'll say it's in Dane County. Right now we have, this is the amount that you would get annually for your HRA, $8,000 from your employer. We're going to continue there. You have an income of $100,000 and you're 60 years old. Get your results. And this says you should decline your HRA option. Now, obviously, if we changed any one of those factors, that would change the answer here, or could change the answer here. So if we change the zip code, it could be different. If we change your age, it'd be different. I'm going to change this to $9,000. And at that point, we come back here, same, everything else held the same. And now it says declining would also still be a good idea. So at some point, they can, you could get to a level where it said you should accept it. I believe it's at 10,000. Whoops, not 100,000. That one you should accept if they're giving you 100,000. So now it's saying you should accept it. So somewhere between 9,000 and 10,000 is where it's switched that you should accept the HRA. So that's usually done through the employer. It is your responsibility to generally to actually actively decline it. If you are offered it, you are kind of auto enrolled generally through the employer, and it is something that you want to actively take as a benefit. There is no tax reporting that is submitted to you for this, so it's on the employer to send those in. But generally, in the healthcare.gov application, if you put in that you have an HRA, it's going to say you automatically do not qualify for a subsidy. It is your responsibility to figure out if it's qualified or not, and then actively decline it if it is not qualified. And there is no hard set rule of an amount that's qualified. It varies based on the cost of a silver plan in your area, so your zip code, your age, your annual income, and the size of your family. So a lot of factors there to figuring that out. The only way to really do it is use this calculator, which I had to search for on healthcare.gov for about 15 minutes to find. So if you have an HRA, you definitely want to consult a healthcare specialist so they can help you determine the viability of taking or accepting that plan. I'm going to go back to the PowerPoint. Whoa. Just. So I gotta skip ahead. What slide were we on? All right. So point of this is absolutely you want to consult a professional to help you navigate that. You may also have a benefit when you are retired. Some unions and different organizations may offer that as a benefit as a retiree. You may also qualify for an HRA that they will continue to give you benefits. Those are also another mixed bag. We usually have to contact the provider of those to find out if they are qualified as an HRA. And we tend to get varying answers. I've had some people who at one point told us, nope, we were in a meeting, they told us they are definitely not an HRA. We called the company providing the payments and they said, we absolutely 100% are an HRA. So it can still be a little confusing even when we get to that level. So the short of this is consult a professional if you're working with HRAs so that you can make sure you're getting the best advice and taking advantage of the most either subsidies or benefits that you could get from either of those programs. With that, I believe Ben's going to come up and he's going to talk a little bit more about how some of these different plans can affect your Medicare. Thank you.
Hello, everybody. Ben Rothering here with WDS Health. I am the Medicare specialist in-house. So there are a number of different plans that we run into as you become eligible for Medicare. If you are someone who has an HSA, something that's very important that we want to make sure that you take care of is you need to stop funding your HSA 6 months prior to starting Medicare. Okay. So if that means you're going to go on Medicare when you turn 65, then you want to stop 6 months ahead of time. Now, if you plan on working beyond 65 and you have an HSA, you can continue to do that. You just wouldn't take Medicare at that time, right? When you take 65, you wouldn't take any part of it out. When you are thinking of retiring, we have to look a little bit into the future and realize that, well, you have to stop contributing 6 months ahead of time. So you got to do that and know, 6 months out when you're planning on retiring. So that way, then you can enroll in Medicare. It will actually start 6 months back, which is why we want to make sure that you don't have your high deductible plan with the HSA and then any part of Medicare on top of that. Otherwise, there can be some tax penalties that you may run into. So good things to ask, good questions to ask. And as Shane had mentioned, making sure that you're talking to a professional Medicare specialist so that we do things in the right order. Okay. Another thing that we run into are state plans. So if you were a state employee and let's say you have sick leave benefits and now you retire and now that sick leave is going to continue to pay for your health insurance until that bank of money runs out. That's just fine. Always a great idea to talk to your HR department wherever you work. Okay. But with ETF, with state benefits, once you retire, you're going to want to take parts A and B of Medicare. And then that sick leave, that bank of money is going to be paying for the options that ETF is offering you. Okay, so it's basically extended group coverage. Okay, when that bank of money starts to run out, then you will have the opportunity to either pay out of pocket for the options that they're offering you, or what you can do is when that runs out, you can go and research, advantage plans or supplemental plans to help with Medicare. That's again something that I'm more than happy to do. I can show you all the different options and run through the pros and cons and figure out which one's going to be best for you. Typically, what's going to happen is you're going to want to go with an advantage plan or a supplement when your sick leave runs out. More often than not, that if you're going to pay out of pocket for that extended sick leave, or the coverage that they're offering you through ETF, it's a little bit pricey. You can certainly save quite a bit on premiums by going another route. With federal plans, this is a whole nother animal. It's recommended that you take Medicare when you're eligible if you're a federal employee and you're retired. They can't make you, but if you don't take it, when you're first eligible, you could get a penalty down the road. So it's recommended that you take Medicare Parts A and B, when you're able to, and then those federal benefits will continue. Now, do you need an advantage plan? Do you need a supplement? What are all the rules involved with that? You wouldn't necessarily need a supplement. You could potentially suspend your federal coverage and then choose a supplement or choose an advantage plan if that's the route you want to go. Again, there's pros and cons to all of these things. If you stick with the federal coverage, which I've heard is pretty decent coverage, you're still choosing what's offered by that federal health plan. And you may have some limitations. You may have HMOs, some PPOs, stuff like that. Okay. Medicare will be the primary and that federal coverage will end up being secondary. But you may have some of those limitations. You could also potentially suspend your federal coverage and then go with an advantage plan. Again, that's going to bring you into HMOs, PPOs, stuff like that. They may have some other coverage. So that's something that we would want to compare, see who's offering what, where's the best coverage going to be for you. A supplement, if you decide to go that route, the nice thing about a supplement is it travels wherever Medicare goes. So it gives you a little bit more freedom to go to any doctor, anywhere, anytime, and you don't need a referral for a second opinion. So moral of the story is we should definitely do our due diligence and do some research and figure out, well, how much is it going to cost for you to pay for that federal coverage? Or how much would a supplement be, or an advantage plan? What's the coverage within each of those? And how does that fit you and what you're looking for as far as your healthcare coverage in your retirement years? So a lot of different options there, and certainly more than happy to go through all those with you. I think that's it for me. So I'm going to hand the reins right back over to Luke, and we'll keep moving on. Thank you.
So before I alluded to, you can make withdrawals on an HSA from previous year's expenses. So the look back period of how long you can go back to reimburse yourself out of your HSA for medical expenses was back to the year that your HSA was open. So if you started your account back in 2005, any expenses that you did not make withdrawals out of your HSA to reimburse yourself on that were eligible in that year, you can now make those withdrawals this year. So there is a school of thought. It's a lot of record keeping, and I don't necessarily advise it, but I just want to address that you can do this. Is you pay all of your medical expenses out of pocket, you max contribute to your HSA, and you keep those receipts, and now it's a new form of tax-free income in retirement because you've already paid those medical expenses, but you have never reimbursed yourself for that. So each year you can have a $5,000, $6,000, $7,000, $10,000, $15,000 of medical expenses that you paid out of pocket previously, and now you're going to make that withdrawal, and it's a tax-free withdrawal at that point. A lot of record keeping. That's the major negative behind that. But it definitely is a strategy that exists out there. For some of you, that ship maybe has already sailed, depending upon the age that you are in, and if you're still eligible to make those contributions. Really, the whole point of our presentation today is to let you know that this stuff gets really complicated, and there are really three parts to do really good planning. And we want to let everybody know that it is available here at Wealth Distribution Strategies. I've had several meetings with an advisor and Shane and myself, and we figure out exactly what income level we should be targeting, whether it's Roth conversions or adding that income, capital gains, those types of things, to keep your income at an optimal level to maximize the subsidy that's available for you. Having been here is very beneficial for not having to look elsewhere for that Medicare advice. It's a very complicated plan that I definitely am not an expert in, and Shane is not an expert in. So we really have our areas of expertise, but we do know how to work together to come up with the best solutions that way. So at this point, I'm just going to open it up for any questions. If anybody has anything burning, enter that in the chat, and we'll get those questions out. The other thing I'm going to point out at the bottom of the page here, you can see that all of the slides have been basically taken from the IRS publication 696. So it's one of the easier publications to read from the IRS. It's only about 28 pages. And it does go into detail on all of these topics that we talked about as far as the different health plan savings. So if you're wanting information direct from the source, that's where that's coming from. So we'll give it a few seconds. Are we getting any questions coming in from the chat? No? Okay. Well, perfect. We are going to have this available on our website. So you'll be able to view this there if you came in late and missed the beginning and want to double check. And with that, I'll say thank you. So, oh, we do have a question coming in. Yeah, so basically there's a statement on one of the clients was trying to get a HSA instead of a flex spending account at their employer. It's totally up to your employer's discretion. So there's not really any advice that we can offer on that, unfortunately. All right. Thank you so much and have a wonderful day.